down the milk.
Okay. Thank you, Kevin. All right.
You're welcome.
Welcome, everybody, to the September 12th, 2023 edition of Bull Sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by my dear colleague, the magical mathematician of mid-Michigan. And I'm sticking with magic this time, Ken Kabula.
All right. Good evening, good afternoon, good morning, everybody, wherever you're joining us from.
Magical is a lot better than maniacal, so
I guess it is. I'll take it. All right.
They both.
I'll go with magnificent. Magnificent is the better.
All right, and that third voice you're hearing is Kevin Galogly, and Kevin's been with us the last several weeks, and he's hanging out just to heckle when time permits. And we also have Matt Spielman from Houston in the back room, and I think Matt's probably going to want to chime in on ResMed as we get to that a little bit later. Okay. All right, so we are going to spend a few minutes talking about Betty Sinnock and the Beardstown Phenomenon later. Betty's a dear friend, and she passed away a few days ago. Her funeral was actually yesterday, and she was pretty much the ringleader, or certainly one of the ringleaders of the Beardstown Ladies. And the picture that you see there was celebrated in the 50th anniversary edition of Better Investing magazine. And I helped with the article, spent a fair amount of time with them. I've actually attended meetings in Beardstown. That is them sitting at the edge of town where all the clubs and everything are on the median. And the ladies have been a joy over the years, very supportive to our Chicago chapter efforts in Chicago in the mid to late 1990s. And she definitely made a massive difference in the world of investing. And just like it says there, the theme behind that article was promises kept. They're very simple promise, very direct. They have a bunch of teachers, by the way, in their group, was anybody can do this. We'll show you how. And I think in the realm of helping other people discover and explore and experience long-term investing in the way that the modern investment club movement does it, again, I just raise a prayer of thanksgiving to Betty and the Beardstown Ladies. Ken, your thoughts?
Well, do you want to hear what I have kind of put together for Betty now, or you want to wait till we get to her slide, Mark?
We can wait till we come back to it. That kind of kicks things off.
Okay, let's wait, because I have a story to tell when we get to her slide.
I have one too. I couldn't remember if I have told the San Jose story here ever, but anyhow, it could be some fun later. And of course, Dumb Money is a reference to the movie which just came out of the Toronto Film Festival. It's based on the GameStop Reddit experience, and I think it's going to be an unexpected pleasure to watch that. I actually sat through and experienced firsthand. I was in the trenches of the GameStop thing as it was happening, and it was a whole lot of fun. And Kevin, in case you're wondering, I still do hold my shares of Western Alliance.
I'm shocked. You're hanging on to for what, over a week now?
All right. Here's our reminder that Portillo's is not a sponsor of this session, but they should be. All right. Here's our.
I'm wondering, Mark, have you ever gotten any kind of communication from Portillo's thanking them for all this free advertising?
I have not, but maybe I will try to ding them with a direct message on X Twitter or whatever we're calling it these days. All right, here's the standard disclaimer. Again, the stuff that we talk about here is for illustration and demonstration. This is all about education and sharing. We're basically talking about the lessons, the methods, the methodologies, the techniques, the philosophies of the modern investment club movement. So you'll hear our opinions about those things. Please do your own review and conduct your own analysis and make your own decision about any investment that you pursue. If we own something, we try to remember to disclose that. Please do your own homework. We do have a monthly program known as the Roundtable. We've been doing it since 2010, and it's just basically 4 or 5 of us coming together to share an actionable idea. And it's got a pretty good track record. If you'd like to be added to that reminder for the monthly webcast, it's generally on the last Tuesday of every month, 8:30 Eastern Time. Send an email to nkabula1@comcast.net. It is a public, free program, so invite your friends. And in fact, the motto for the next meeting is going to have something to do with friends don't let friends be average investors. So probably a good one to invite someone to. If you have any questions or suggestions, my email address and Ken's email address are at the bottom of the page. Anything you'd like to add, sir?
No, I like the newspaper boy clipping in the bottom corner right there.
He's lingering. That's Kevin. That's Kevin from 1969 Chicago.
Okay.
That's exactly how we dressed when we delivered the newspapers in the wintertime. Yes.
It must have been it. All right.
Or maybe that's
No more comments. Let's keep going here, Mark. Okay.
could have been Ken in Cleveland too, I suppose. They probably made you wear uniforms there. All right. Stocks are down over the last several weeks with the light green bar out at the far right is represented. It's our measure of the index of the stock market as measured by the value line arithmetic average. That's an index of 1,700 stocks. And we refer to it as an all of the above, small, medium, and large, all inclusive index. And you can see that that line was actually up at the blue line, and it has sagged back off of it a little bit. So the return forecast has actually increased a little bit. So you can see here it's come down a little bit off that long-term trend line, just a mathematical representation. The red dots and the red trend lines are basically the aggregate average forecasts of all the companies that we follow. MIPAR stands for Manifest Investing Median Projected Annual Return. So it's literally taking all of the companies and stacking up all the results of the stock studies and coming up with an average or a median. And you can see we're kind of down in very normal territory for that also. Anything you'd like to add, Ken?
No, I really do like to see the different red lines from month to month, Mark. This is a new one that you started with last month to put MIPAR in there, because I think it emphasizes real nicely the closeness of some of these measures and how that number of 9.5, 10, 10.5, 11 for the average return keeps coming back to kind of square at us time and time again.
Mm-hmm.
It's just a great representation. Maybe what we should try to do is make this graph a little bit bigger once in a while and put on 2 or 3 of these lines in drastically different colors and show that you can't even see them because they lie so closely on top of each other.
Yeah, I'm tempted to put 3 or 4 of them on the same page so you can see that the work that we do in the Modern Investment Club movement, the collective effort that we do is very much joined at the hip with Value Line, and we can show that on a slide.
Yep.
All right, good stuff. All right, here's just a little bit more follow-up on, I found this as I shut my machine off 1 week ago, and we had talked about, were we seeing signs of recovery at Service First Bank shares? And we looked at a number of things, and then I discovered that I could actually pull up the trend of total deposits, because the bank is telling us this. But you can see that there's definitely been something of a recovery in the action on total deposits. So it's actually come back, and it's seems to be headed back for what seem to be fairly normal levels down here. And I think this aligns fairly well with some of the stuff that Matt has been publishing on a variety of different banks in the forum. So it's kind of comforting to see this. And my expectation is that we keep seeing more stuff thrown at the banks. It seems like every morning I get up and they're being asked to do something new and different. And I don't know, eventually we got
Mark, are you Are you familiar with Key Bank?
I am familiar with it, yes.
Okay, they call it a super regional bank, and they had the CEO of KeyBank on, and we're doing quite a lengthy interview with him on one of the Talking Head programs on CNBC. And he went off for about 2 minutes chastising the panel that was trying to get him to say something silly. And he went off and indicated that, they never report on the good trends in the banking industry. They just want to jump on the negative trends. And he talked about this very thing that you're demonstrating on the graph here, that the racing out of the regional banks with deposits has ceased, and the movement has been back into the regional banks again for the flexibility they offer a lot of their customers in keeping deposits there. So it's not only in Service First Bank where it's happening. The Key Bank exec indicated that you could notice it in almost any of the well-managed banks that were out there in the cohort, that it was improving again. It had moved from negative back into positive, and his expectation was exactly what you thought was going to happen. They were going to go back to normal levels of growth again. So I just want to, rubber stamp that remark and indicate it that it's coming from a lot of people, not just one or two people in the industry, but it's coming from all over the industry again, that if maybe we don't drive people away, we're on the road back to normalcy in the regional banking industry.
Yeah, and Matt may have something to add, but I mean, I woke up this morning to Jamie Dimon of JP Morgan basically blasting some of the Basel III recommendations that are floating out there, that it appears that they're going to be quite a little bit of heavy lifting for many of the larger banks, which had been kind of a defensive oasis. And Jamie was not happy, and I'm sugarcoating. So
oh yeah, he was very colorful. I was just gonna mention his comments today too, are not entirely positive. Of course, the quote that's caught up is, "I wouldn't be a big buyer of banks."
I saw that.
Which
I saw that. It made my shares held in JP Morgan cringe.
but the context is everything you said, right? So if there's a lot of, let's just say, red tape to muck through in the future, that's not going to be a positive. It's going to be a headwind. But of course, the headline grabber was the headline grabber. I will also say, in the Wall Street Journal today, had an article talking about the increased use of brokered deposits, and characterizing them as short-term things. And we've talked before here about an acquaintance, an online acquaintance. We have a couple of bank examiners in the community, which has been a great help educating everyone, including me, on this. I have someone on the other side who is a risk management executive, and he said he would tolerate or be okay with average bank profitability for a 100-year franchise in this environment, because their customers probably aren't up and moving, based on Jamie Dimon's latest CNBC interview. And so the Wall Street Journal's point was, broker deposits as an increased amount or a place to turn are relatively newcomers, and therefore jumps the logic they could leave pretty quickly. But that is an aspect that some banks report on and is in their FDIC reporting, so you can see what that is, because that is unevenly applied as needed by the banks. But it's also not entirely true, in the sense that a lot of that brokered money is brokered deposits, or I'm sorry, brokered CDs. So not, there is a lot in the money markets. So you can see exactly how much is in money markets, but the idea of brokered CDs being a bad thing and growing this year, I think, is a little out of tune, because all CDs are growing this year because they finally pay more than 0.1%. I've gotten interested in CDs too for the first time in a long time. So I think that's a little bit of making a mountain out of a molehill, but it's a point of view to understand for what the market says, and just because the landscape is changing to the tune of $1 trillion.
Right. Yeah, I was recently in a money center bank, and they had fairly recently had a rate as low as 0.1% on savings accounts, and they were throwing 4 and 5% numbers at me, trying to lure me in. So yeah, things are active and changing, but again, we seem to be always fighting the last war. All right, let's go ahead and crank through some stuff here. Did want to talk just a tiny bit about this movie that premiered at the Toronto Film Festival, Dumb Money. Again, it's based on the experience of the Reddit, GameStop, the Citadel, and hedge fund, and it's actually had pretty good reviews so far, better than average, and very few Rotten Tomatoes and all that kind of stuff. So it's interesting. It opened in Toronto. It'll actually be in theaters within the next couple of weeks, and we'll probably come back and take a little bit closer look at it. And to me, it kind of dovetails with, a lot of times I hear retail investors referred to as kind of dumb money, and you get a lot of that type of thing. When you start talking to the rhinos or the talking heads on TV, and sometimes that dumb money isn't so dumb, and that's going to be part of that message. I think that the story behind the story of that particular incident will prove fascinating, and we will be taking a little bit closer look at it. All right. Any other comments on that?
I really like the Brookhiser quote, Mark.
Well, the one below it is the one that I really like, because we're going to talk about that for a second, and it's in the theme of September and October being turbulent, or a rough ride of sorts. That happens to be me in the back of that kayak and my wife in the front, and that's on Lake Superior, and that was on a rough day on Lake Superior, and that's an actual quote from the guy that was helping us out that day. And those are worst case scenarios, but they happen all the time. And I was supposed to be comforting. It didn't work. It was a tough day. And then that image on the third from the left there, if you're not,
I know what that one is. Yeah.
Go ahead.
That's the guy in the hamster wheel, right? Trying to get across the ocean.
Yeah, and arrested by the Coast Guard.
Right.
Trying to walk across the ocean.
Yeah, not for the first time, Mark, evidently.
That's what I hear. So
he's been arrested by the Coast Guard 8 or 9 different times for doing some of these stunts.
So that all ties into this slide. So I left the 2 pictures on there. It's just a reminder that things get a little bit crazy this time of year. In fact, back when we had national conventions in October, you could almost count on the stock market tanking during the convention. And here Eddie Elfenbein just reminds us, he's taken I don't remember how many years he went back, but he went back several years and just looked at the percentage gains day by day for the calendar year, and just basically demonstrated that from early September through the end of October, things can get quite bumpy. So in our community, we dumb money investors basically see that as an opportunity to accumulate, because we believe that price volatility is actually opportunity, not risk. So I think that's a good thing to remember while the woes and the whining go on here over the next few weeks. Your thoughts, sir?
Graph kind of says it all, doesn't it, Mark?
I think so. It's just a good reminder that maybe you can find something on sale. All right, let's keep on trudging. Here's a quick check-in on the Groundhog Challenge. And Ann Renly held down first place along with Nick in second. There's been a little bit of shuffling. Ken is making his charge up the list.
That's
without our Delex.
You're doing everything you can to jinx me, aren't you, Mark? Okay, I got it.
But a lot of familiar names up at the top. We have a little bit of turnover. Marie Frank joined the list down at number 40. Marie has been a wonderful source of ideas over the last several years in the forum. good to see her doing that and hear from her. And again, those clubs, some of them very tried and true, including our 3-time champion Bower City Ladies at number 36. They're dangerous. Good stuff.
Mark, help me out, or maybe Matt, help me out. Is Lone Star the Dallas club?
Yes, it is.
Yeah.
Go ahead, Matt.
It is? Okay, great.
And I thought we'd take a little bit closer look at this one because you guys have heard us talking about this several times over the last few weeks. You know, right now the Wilshire 5000 is checking in at about 7% since Groundhog Day. And the value line arithmetic average is actually nearly 12 points behind that, 12 percentage points. And that's really more unusual than we give it credit for. That's why we have been talking about it probably being prudent to step up shopping amongst the smaller and the medium-sized companies. And we thought we'd spend just a little bit of time with that. By the way, Ken, Kathy's back at 76. She's bouncing around pretty good. So, good stuff. Here's a look at the Wilshire 5000 top 25 holdings. You can see it accounts for nearly 40%. Lynn Douglas has done a lot of work in this area, pointing this out. And those top 7 or 8 stocks, in terms of percent of total assets, you can see there's quite a few of them in here. That adds up to a pretty sizable chunk. And when you look at the performance of that group of stocks over here, this is since Groundhog Day. I think you can see that is basically carrying the Wilshire 5000 in many ways. A couple exceptions being the fat pill people at Lilly. This is the Broadcom situation where they are taking over VMware, acquiring or merging with. And then the last one down here is Matt Spielman's Adobe, a recent roundtable selection that's doing pretty well. But other than those 3, the rest of those are pretty much in the dumps. So what else do we see?
I wonder, Mark, why they insist on separating the 2 Google shares into 2 holdings. I would rather think of Google as being 3% plus of the whole, of the whole thing, rather than seeing it at 175 and then seeing it again at 148. Yeah.
Well, I mean, and for those not aware of it, they're in the middle of an antitrust court case right now with the federal government. So maybe they're going to need both classes. Who knows? But the difference between the 2 classes is minuscule in the grand scheme of things.
Absolutely.
So yeah, they're obviously
Isn't the difference just voting rights? Isn't that it?
It's pretty much it.
That's it, Kevin. I mean, there's other things listed when you read through everything, but effectively it just has to do with voting rights. That's all.
Yeah, and
I always forget which one has the voting rights, because that's the ones that the owners have, right? The founders.
Probably I really don't know. I think Google A is GOOG without the L, and that one has a slightly higher price, so I'm guessing that one's got the voting rights.
Yeah, the owners have a super voting share.
They're super votings, yeah.
They're owning a 3rd share, Mark. They're not owning either of these 2 here.
It's the owners. The founders have super voting shares, but they created the non-voting share class to give themselves some more super voting shares and keep their effective majority.
It's a complex structure, and I'm with Ken. I just as soon see it go away at some point. Anything else? Because here's a look. Here is a look at over this year's Groundhog contest. You're looking at the Wilshire 5000 in red and the value line arithmetic average in blue. And you can see basically the slack performance for this larger group of companies that it's not larger, but the group of companies that we commonly follow as the stock market, the value line arithmetic average. So that's just during the Groundhog this year. I think the next one I went back and took a look at what is now a 10-year phenomenon for the Vanguard total stock market. Again, that is the Wilshire 5000, and you still see quite a performance differential here over that longer term. And that has not been the case very much. I mean, they can see that the break started happening somewhere in here, the divergence to that side, maybe back as far as 2015 or 16. And again, those companies at the top of that previous page are the ones carrying that to a large measure. Even this particular is just since Groundhog Day, but if you go back and look at that over 10 years, you see a similar thing. And the reason that is really kind of nudging at us, or at least tugging at us and suggesting, is because here's a look at it for 2022 years. And you can see that the value line arithmetic average, again, the all of the above index that we follow as the stock market, has significantly outperformed over the longer term versus the Wilshire 5000. And I mean, it's stark. So that's why when you hear us talking about this condition being something we don't normally see, we've seen it for a few years, this is what we're more used to, is all we're saying. Does that make any sense, Ken?
It makes a lot of sense, Mark, and it points out the reason that you should be very aware when you're looking at graphs where they begin. A lot of times financial graphs are drawn so that they, no matter what they're following, they both start at the same place on the x-axis, if you will. And when you have short-term graphs, many times you can cherry pick and come up with come up with proving almost anything you want to prove. I'm just not so sure that some of these shorter term graphs are telling the true story, unless there's been a real shift in the way that investors are investing. But to make those two come back to be close together, there's going to have to be a continued measured shift in one or the other, isn't there?
Yeah, and there is a school of thought, and it's maybe something we could dig into. Ben Carlson has done some work in this area where he talks about the increase in passive investing, the increase in the amount of 401k dollars going into S&P 500 funds and that sort of thing is perhaps somewhat aggravating this stuff. I don't know. We'd have to dig into it a lot deeper. The S&P 500 is in both of those charts. You know, it's embedded in both of those that you see there. So just something to think about. All right. Okay, here's a quick look at our, I added another rabbit for luck, Ken. We got to get to the right number of rabbits to help us out because we've dipped back again.
It sounds like desperation, Mark. Is one of these rabbits called desperation?
That they keep it up, they're going to see a bunch of them. We were catching up. That came to an end. Again, the smaller companies lagging those monsters at the top of the Wilshire 5000. This is the Wilshire 5000 that you're looking at right here. Making life difficult for us. We are grateful for Technoglass and Yeti and Monolithic Power and Fox Factory in mode, but our gratitude wanes as we go down the list. And I'm ready for the banks to have a couple good months before Halloween. We're running out of time, Ken.
Well,
but you're not going to get rid of that fifth one from the bottom, are you?
Oh, no. That'll probably carry over into the next year list.
Asking for the audience.
And that's without any undue influence from Portillo's. So, all right, we'll come back and look at these a little bit closer.
We just have to remind people, Mark, that 1 year contests, 1 year timetables are not where we're really coming from in our investing philosophies, and that we're much more interested in what happens on the 3 and 5 year or even longer timetable with our investments.
Like
that,
that
the 1 year can be interesting, and sometimes you can beat what's happening, but It doesn't have a lot of meaning when you beat. It doesn't have a lot of meaning when you lose either. If you've picked companies that have the right kind of management and the right kind of growth characteristics. I'm not saying that all 10 of these do, but there are certainly stocks in the bottom of that list that are a heck of a lot better than they're showing right now.
Yep, I would agree with that. And, you know, we get frustrated. I'll tell you, one of the things that drives me crazy is the fact that the clock runs out on Halloween. And I don't know how many times we've given up on a company one Halloween to have it be in much better shape 1 year later. In the context of this demonstration. Again, keep in mind we had 7 years in a row where we trounced the Wilshire 5000 and one where we didn't. It was close, but all right, enough. I'll stop roiling in the mud. All right, we said we'd come back to this again. This theme of promises kept. Again, Betty passed away a few days ago, and she was a good friend. Hailing from the Beardstown / Springfield, Illinois area, she served in many capacities for the National Association of Investors, and she was, as I mentioned earlier, very supportive of us at the Chicago chapter back in my days there. And I could tell lots of stories, but I think, Ken, you've got one you want to share before we get started here.
Well, it involves the history of my own chapter, Mark. In the mid-90s, the Mid-Michigan chapter was down to a single director, and it was called a consul then, the Mid-Michigan consul. We had one director, and that director sent out a letter to all the members of the consul, and this was big time membership during the mid-90s and the late 90s. And that letter went out saying that he was going to take the treasury of the consul and return it to headquarters because he needed help in running the programs and everything else, and there wasn't anybody willing to help. That letter generated a meeting where over 100 members attended the meeting, and about 50 or 60 of them volunteered to be directors. And during those formative meetings that went on for a period of 8 or 10 weeks, we drew together a group of about 35 directors and some very interested people. I became the first president of the newly reformed Mid-Michigan chapter, which was a lot smaller geographically than it is today, and which had about 10 times as many members as it has today in its smaller geographical footprint. At that time, we just happened to get an executive secretary from Dow Chemical retiring, and her name was Ramona King. And Ramona had a lot of the same characteristics as Betty Sinnock. She was a go-getter, she was an organizer, and she knew how to get things done. I'll tell you, she said, we're going to have an investors fair, and the other 35 members of the board said, what the hell is an investors fair? Ramona said, I'm going to the convention in October. You're going to pay for it, and I'm going to find us speakers that will draw people to our investors fair. And Ramona went to the investors fair, talked to the Beardstown ladies, and convinced Betty and 5 of her colleagues, that's a total of 6 Beardstown ladies, to come up to Midland, Michigan,
Cool.
to drive up. And Ramona says, I have enough bedrooms to put you all up for the entire weekend, and you're going to speak. And Betty said, we don't normally speak at these kind of things. And Ramona says, I'm sure you can find something to say. And so they came up to Midland, Michigan. Midland's a wonderful town known for Dow Chemical and known for the philanthropy of the Dow family, which has done all kinds of great things in that small little town out in the middle of nowhere. Betty and her friends came up. They presented a wonderful, wonderful program for us. They convinced us before they came up that we should invite Tom O'Hara and his wife to come up, even though they were in their 90s at that point. And so we invited them to come up, and they showed up as well. So here we are with 6 of the Beardstown ladies and the legendary founder of Better Investing, and they're all telling us what we should do next. And we attracted over 500 people to that first investors fair. It all had to do with Betty and her friends, and the message was very clear and very easy to understand. And basically it was, this is easy. There's just a few rules. Learn the rules, do as NAIC says, and you too can become successful. That was the grounding point for tens of different investment clubs that were formed in the next couple of years. It was the point that turned our group of 30 to 35 directors into believers, into apostles for the message. And I'm still honored to be on a board with 8 or 10 of those original directors. Wow. And a lot of it's due to Betty and her message, and a lot of it's due to Ramona King and her spirit, which was just so like the Beardstown ladies that I'm sure if she would have been 3 hours closer, she would have asked to become a member and driven down there. So
I could just picture Ramona in that mode.
Yeah, I just want to all the thanks in the world to Betty Sinnock and to these ladies that gave us something to follow and basically to be richer in spirit, but also richer in dollar terms than many of us ever thought we could possibly be.
Thanks, Ken. Yeah, in fact, during my last visit to Beardstown to attend one of their meetings, Betty threatened to bring me in as a member. I don't know if she had a gender change operation in mind, but I was honored to be at least thought of in that way. I have a couple of stories. One, the bad side and the good side. I mean, I was actually with Betty the night after the article came out questioning some of the math in their Disney book out of a Chicago publication. I won't even say the author's name or the publication's name, but it was nasty. And she was in town to give a presentation at what we had the Chicago volunteers put together a program called the Breakfast Club, and she was our keynote speaker that morning. So I had spent all of Friday night and most of Saturday with her, and she handled it with chin up and the appropriate level of optimism. It was an honest mistake that was made, and you can read more about that in some of the stuff we've written about over the years, but a good time. A month later, Tom Gardner from the Motley Fools was our keynote speaker at this Breakfast Club, and he went deep off the deep end with a tribute to the Beardstown ladies and basically pointing out how many people they have enabled and empowered versus the people that were basically slinging these arrows. And so got to see that all up close and personal. And like I say, she handled it as the consummate professional that she was. Now, the other story, and you mentioned Tom O'Hara and his wife, back, I believe it was 1998, Ken, out at the National Convention in San Jose. I think I may have told this story here, but I'm going to tell it again because it just illustrates her spirit. And so I'm out at this convention. It was one of the larger conventions, maybe the largest convention in the history of Better Investing. We had a few thousand people. We were at the San Jose Convention Center. And in fact, Better Investing had one of those booths that you would see at a trade show. I think it even had an upper deck with a green room sitting area up there and just this massive, long, probably almost 40 yards long counter. And much of the Better Investing staff, the administrative staff was there manning the booth. And Betty had asked me to go and do a favor for her, pick up some books because they were having a book signing. And I had done that. And I came back and I was kind of standing in the middle looking around for Betty. We were going to meet in the entrance area, the lobby, right across from the Better Investing booth. And all the ladies from our office were there. And Betty comes walking up, and I hand Betty's key, the room key, back to her. And she comes up and she gives me a little peck on the cheek and says, "Thanks, Mark. You were wonderful." And we both looked to our left, and here's the entire Better Investing administrative staff with their jaws hitting the countertop, and they're all just like in utter shock. And she basically did that just to set me up and have a good time, and it was a wonderful moment. So it just shows her sense of humor, and just a great contributor to the long-term effort. So good stuff. Anything else you'd like to share, Ken or Kevin or Matt?
I'm not.
I was going to say the one thing that I can remember is that when I got involved in Better Investing, I was home for the holidays back in Chicago, and my mom had both the book and the manual from the 1990s. And someone had given it to her, and I just started reading both the book and the manual, and it just made a lot of sense. And right after that, I got together with some friends back in DC, and we started our club.
Cool. All right, so we'll press on again. Thanks, Betty. Thanks for everything. Rest in peace. All right, I thought we might take a moment and spend just a few moments with this. This is an excerpt from the homepage. Just wanted to point out that this is actually a page that can transform all week long as some of these audits are done and some of the company updates are done. Just wanted to spend a couple of minutes going through a few of them, make sure that everybody's aware that they're there. So I'm going to go ahead and jump out and go to the site live, Ken, because I think Ken's going to enjoy this. Some pretty good stuff here. Just going to our homepage. Let me go ahead and bump it up a little bit. I'm going to do some housekeeping here. Bear with me. So if you go to the homepage, you'll basically see these weekly updates. In this case, this is a reference to that movie we've talked about a little bit, the GameStop movie. But if you go into the weekly update, you can see that we generally will cover that same graph every week, or some form of that graph, along with some features. There's a few words there about Betty also. Then we've got these audits, and or any of the updates. Fastenal, I'm going to throw this one up as an example of up, straight, and parallel, and the type of company that we just love to find. And I wanted to also point out that in this case, because it's a roundtable selection, it's also in our 40 most widely followed companies by Manifest Investing subscribers. You can see that we actually are sharing the details of the roundtable selections. All three of those selections made by both Cy and Ken, and then also consensus picked by the audience back in 2013. And over that time frame, you can see that what each $1,000 position has become. You can see how it measures versus the total stock market over that time frame. So that's been a pretty good one, Ken.
What I like about a stock like Fastenal, Mark, is that it demonstrates what you can do to a portfolio, and you don't have to, send fireworks into the sky and have huge home runs on a regular basis. If you can put together a portfolio with 10 or 12 stocks like this that are going to beat the market somewhere between 1.5 and 2.5 percentage points over long periods of time, your money's going to do quite well. And you add to that maybe one home run every 10 or 12 years, and you have a portfolio that can stand up against any portfolio that I've read, whether it be a hedge fund or a mutual fund or an ETF or anything. You can be proud, and you can live a retirement where being able to spend a little bit of money on frivolous things is something that you're able to do on a, if not on a regular basis, at least on a semi-regular basis.
Yeah, and one of the things I like about this one is, first of all, the consistency. You don't get much more up, straight, and parallel than this one. It's not an exciting company, but it's exciting in our community, that's for sure. On the far right-hand side, you can see the value line, 3 to 5 year forecast, really does seem to be a bit pessimistic. All the other points touch that trend line, going all the way back to 2012. So that would just suggest, as you're looking through, and again, if you're a stock watcher, or if you're simply doing a stock study on a company like this, and you start seeing slightly different results from different places, Morningstar, the analyst consensus, in this case, value line, this does kind of stick out as something you might want to scratch your head over. They could be right, but they could also just be needing a little bit of a shift, maybe from second to third gear on that particular situation. You'll see that when we go through some of the home builders here in a minute. All right. Which one did you like to look at now, Ken?
Well, you know how I like D.R. Horton, Mark. It's one of my larger holdings, and it's been a home stock that I've really considered through thick and thin as doing as well as anything in the home building market, and better than most.
Yeah, and I think this is this again is the issue 6 from the value line. So it's got the residential construction companies in it, in addition to companies like Fastenal. But I think you can see there's a couple companies here that are, I have to call installed building products as a little bit obscure. I mean, I think UFP, pretty sure that was Universal Forest Products when you picked it, Ken. So
maybe, but I own both of those companies.
Mm-hmm.
I own IBP and UFPI.
So let's go ahead and take a look at D.R. Horton. And here again, you can see this is a multi-year selection. Again, I'm not trying to jinx anything here, but I do want to point out that back in that time frame, there was a whole lot of negativity about residential construction. Much of it coming from within our community, and again, we think that there's quite a void, an inventory correction that has to be made there. Yeah, there's some issues. There's obviously issues with homes and owning homes and all that kind of stuff. But in this case, you can see that all 3 of those selections, and the audience came along on this one too, Ken, are beating the market in this case by 13-14% over that time frame. So this one has to be something that feels pretty good. And again, the longer term expectations like this forecast out here in the 3 to 5 year forecast have been edging up, and pretty much edging up with almost all of the residential construction related companies in this week's update batch. So what do you see, Ken?
Well, I'll tell you that I did shift my philosophy slightly. I think you'll see that some of my earlier picks were of Tyler Morrison Homes and a couple of other smaller home builders, and I did move to some of the larger home building companies, thinking to get exposure in maybe more than a single geographic market. D.R. Horton builds in a lot of different markets around the country, but that's the only major difference that I see between home builders. It's where the geography is. I still see home building basically dependent on the local economy, not nearly as much on the national economy as you might expect. I like this company here, Tyler Morrison, but it had a much smaller footprint, and it didn't have the geography that some of the larger home builders had. So I don't own this particular one, but that certainly was a nice single pick, wasn't it?
Yeah, I'm pretty sure they're headquartered in Dallas. I wonder if their geographic area is the Dallas region.
Yeah,
I have to confess.
They definitely, Taylor Morrison is doing a lot of building in the Houston area.
Okay.
Yeah.
Yeah, and this is another one that, again, if you go back to our notes from last week, I would be a little bit suspect. Now, I mean, there was the bump up that happened around the pandemic. Some of that bump is literally from what they were able to charge for construction materials back in that time frame. You know, that got quite crazy in around that 2022 time frame, but fairly pessimistic projections for 23, 24, 25. I just wonder if maybe those aren't a little bit pessimistic. And then I think go ahead, Ken.
The other thing I remember in particular, I think it was part of what you talked about, Ken, either at that pick or shortly after, is Taylor Morrison was innovative in the idea of building neighborhoods of rental single-family homes, right? So the point when we talk about home building being affordable or home buying being affordable and being connected to mortgages, the idea of a landlord, you know, a large investor landlord coming in and being your customer, but still needing that housing is definitely, you know, something that now fills developments of hundreds of homes. It's beyond the experimentation point.
Yeah, I don't get hate mail. I never get hate mail, but I get mail questioning my sanity sometimes of stock picks that I make. And I did get a lot of email on my pick of Tyler Morrison that people wanted to know where I was, you know, was I on something? So I still stand by the pick. I still think that it has a lot of promise to it. And I just don't think that I'd be putting anything more than an average holding into home building stocks. Just like I don't think they deserve a 0% in your portfolio, I don't think they deserve a 15% in your portfolio either. And there are a lot to choose from, an awful lot to choose from.
Ken, I think my notes, you just questioned if you were hanging out at the dispensary too much, or
Could have been.
you know, I may have been.
Are your friends Cheech and Chong?
There was a time when Ken lived on the edge of the cornerstone of the legalization movement here in Michigan. Here's a look at UFP Industries, and again, going back now almost 3 years, and outperforming the market by nearly 20 percentage points. Kind of a unique selection. You know, some of those characteristics we've talked about for some other companies. I mean, this collection of rhinos, whoever they are, seem to be a bit pessimistic. Now, it is kind of back on trend, so it's not as bad as that one we looked at last week, but it's right there. But I do find it interesting. These guys win all over the country as long as the trends continue.
I will say, Mark, that I'm in a club that ran from this stock and ran from Adobe both on the same night. And I love to bring up the long-term prospects on both of these companies and remind them that we're long-term investors. We're not short-term investors. We ran from Adobe because it had a really high PE. And while I value PEs, and while I think they're indicative sometimes of problems that a company might be having, and they're indicative sometimes of the market going a little bit crazy over a stock, I don't like to trade on PEs. I think they're misleading in many cases, and especially for stocks that might have a little bit of cyclicality to them, they're downright dangerous to trade on those PEs. So I like to use this one and Adobe as examples of why we don't just look at PE values when we're trying to determine the long-term trends, the long-term growth for any particular company.
This is another example of the type of company that you've talked about, and we have talked about, you know, companies that tend to benefit from a very broad industrial or sector exposure. And this is installed building products brought to us by Kim, again, almost 2 years ago, beating the market by 8 percentage points. And I didn't pick these, you know, specifically. These were the ones that just showed up in this weekly's update. And interesting company that stands to benefit across many levels of home builders and geographies, etc. So doing fairly well.
And this one, Mark, my wife put into her IRA after listening to Kim's presentation. This is the kind of easy to understand company that Natalie likes to put into her IRA, and her IRA is doing pretty well. It's beating mine by about a percentage point right now over the last since 2002. So that's 21 years. It's beating by about a percentage point. So she knows what she's doing, and she really liked this stock. And after listening to Kim and doing her own research, she put it into her portfolio, her IRA portfolio.
Okay, and then another thing that I've just started doing is anytime a company is added to coverage, I put it here. If it's one that really captures my attention, I'll go ahead and do a little bit of a deeper dive on this one. And so, Matt, this is one that kind of caught attention a little bit. You can see it's brand new. There's only very little action going on up here at the top, but here's a historical look at the company. Obviously, the pandemic nailed these guys, but can you tell us what you see? Well, you know, what triggers your attention in this company?
Yeah, well, I mean, first of all, I mean, you look at the returns and they're subpar. I'll say I'm not looking to buy this right now. That the PE is to the higher end of their range, but I do think it's a quality company. This is a company out of Spain. It's an apparel company. Its biggest brand is Zara, and I mean, it's a major competitor in apparel. It's a leader in fast fashion. So the idea that you see something at New York Fashion Week, or on a magazine or something, and as soon or while thoughts are still in your head, it shows up in their stores, or honestly a knockoff, a mimicking item shows up in their stores, and so they can take advantage of other people's prominence to sell clothes. But what addressed me to them was not really even about the product, but how they run the business. I put something in the forum. There's a link to a Wall Street Journal article that talked about how decentralized their decision making is. They use central information systems, so the information about sales of all their stores, and then they match up internally in essence to peer stores, where they think there are demographic similarities to let their individual store managers collaborate. And I think that collaboration and sort of that spirit that everyone is driving the company forward is very interesting, in addition to the idea of where they are in the apparel industry, not just being fast fashion, but also the fact that although most of their manufacturing is outsourced, over 60% is actually in Spain, in the area of their headquarters. So they're sort of nearshoring. The idea that labor arbitrage does not make these, and it's not cheap, but cheaper clothes than the real fashion labels tick. What makes it is fast, and there are interesting stories in shoes along those lines. If you ever read about how New Balance runs their business, it's entirely different than everybody else. So I think they're here too. Yeah. But yeah, I just tickled. I saw it, and it has a major, it has a large market cap. It's over 100 billion, and I saw it wasn't in the BI database, so I asked them to put it in, and they did. So I brought it here too. So this would be one on the watch list if it's anything. But I think it's a good comparison company if you do have an apparel retailer you're talking about, a luxury retailer. And at some point, someone will be pessimistic on it, and it could be interesting to buy.
Mm-hmm. Yeah, and they've got Massimo and several other brand names, and the investor relations presentation is strong on the site, so I would just recommend that. I also have heard some analysts talk about the infatuation or strength behind LVMH, one of the most powerful brand companies in the world, and if these guys catch the same type of fire, there could be some upside here. Again, wait for that opportunity, but good, clean fun. And here's the post by Matt on the article from the Wall Street Journal is right there. So you can go ahead and take a look at that. So with that, I think we'll go ahead and close down with a quick look at ResMed. Again, I do try to watch and see what is piquing interest, and this one is certainly piquing interest here the last few days. I think we'll go straight to it. There we go. this is a company. Let's come down here to what has happened with the price, and I'll let Ken and Matt describe what they think's going on.
Credit to Howard Perry for kicking off the conversation. The fact that it's gone down a bit. I mean, just to give an idea, the latest value line is dated from August 11th, and the price quoted was 222, and today it's 148. So it's dropped quite a bit, and not for any news of the company. The company, and this company makes devices to help with sleep apnea. So you have the mask, and it forces airflow. They do have genuine competition, particularly in Inspire, which is a implanted device. That means you don't have to wear something. But from looking from press coverage or articles associated, CPAP machines, thanks, Lynn. Articles associating Yahoo Finance, this might have caught some downdraft from the rise of Ozempic and the weight loss drugs, something like the weight loss clinics and everyone else that says weight loss has, just because there is some correlation between obesity and sleep apnea. So it hasn't come up yet. I will say it's hard. In my own, I did buy some of it on yesterday. I'll call it a quarter position of that. It's hard to call a company growing sales. The ACE is 9%. I see 11% here. It's hard to call a PE of 24 cheap for that, but it is ridiculously below its range. Value line is looking at an average PE of 36. I struck off 2 of the last 5 low PEs in my SSG, and I still came up with a low PE over 30. So I think that's, just as you were saying, Ken, right? PE is something, it's not everything. Why would a company growing 10% be rewarded with such a high PE? I think part of that goes to what Hugh talks about, or the opposite of what Hugh talks about with Gilead Sciences, right? This company makes a treatment, and it's a condition, and they can help you with a condition, and you'll need their help, as long as you're around, as long as the condition exists. It's not a cure. So they have the device that you buy. Generally, insurance supports you buying new ones every 5 years. They have supplies you need on a repeat basis, and they're growing now a software component to monitor the device and help you and your physician sort of guide your use of it. So a lot of recurring revenue in the stream too.
Yeah, the one thing that I questioned was, you already hit it, Matt, the long-term PE. I don't see 36. I also, anytime I see this situation in a competitive storm, I just got to wonder, are they going to be able to maintain that? Between the competition from Medtronic and Inspire and Lilly and the weight loss drugs, I mean, that would cause me to be a little bit skeptical, but the company is hovering near a 52-week low. It's also hovering pretty close to, it's the 14-day relative strength index. So it's
and lest we forget the re-entry of Philips. So they had a major direct competitor, Philips, which did CPAP machines, which had a recall and had been basically out of the market for a couple of years. What might be like or seem coincident with a COVID bump, but back on the prowl, if you will. I mean, they're not going to get all their customers back right away, for sure. They will have to earn back some trust, but they're going to be working hard for it, I'm sure. They haven't given up the product.
Yeah, and financially strong. I mean, you can see what the banks think of them. Look at that interest rate, willing to loan them money. Obviously, the analysts at Morningstar and the consensus think it's dramatically underpriced at this point. Now, they may correct to the downside, but, there's your look at the situation. And I think you get a little bit of confirmation that this weight loss pill is driving them a bit crazy when you see the price action on Inspire, right side by side.
Yeah, and if you think it's a falling knife, you could put it on a watch list. If it recovered 20%, it would still be significantly below, all the way back to, and the price goes all the way back to 2019. In 2019, their sales were 60% of current.
Yep.
So, I mean, that's not just saying, well, you know, it could be COVID, it could be something recent, it could be Philips. They're significantly bigger than they were back at the same share price.
But the weight loss pill thing is real. I think my wife would testify that my alleged snoring decreases when I lose weight. So, alleged snoring. All right. Anything else you want to add there, Ken?
No, I accept that I do own it, and I continue to own it, and we've added to the position in the last couple of weeks because while we see some problems with competition, we don't see the company going away, and we think that it's reasonably valued right now.
Yeah, and I did drop the PE down to 24 just to bring, this is on my study, do your own work, but in this case, that drops the projected return down into the 15 to 16 range. That's still fine. I just didn't want it to get too far away from this one. I look at this picture and wonder if this excursion here, this surge in demand, doesn't return ultimately to somewhere in here, somewhere closer to 20. And not 36.
Yep. Yeah, that's similar viewpoints. That's a similar basis to where I was making my judgments too.
And I will tell you that, you know, I'm actually more inclined to look at the relative strength index. This is on a 12-month trailing look. It's not a weekly thing. This is monthly, and the weekly is down at 26. When this one hits 30, it really gets my attention because that's a very long-term look at a technical indicator, and you can see they've not been in that area for a long time. The challenge, the problem that they're addressing with patients is not going away. So do not own it, but strongly considering it. All right, just a reminder that these are some of the things we're going to be looking at here in the next few weeks. I'm particularly intrigued by Meb Faber's work on dividends and the perspective on dividends. Here's your reminder that we do archive these sessions and all roundtables at the YouTube channel under Manifest Investing. And in honor of yesterday, I thought we'd just throw up the Clydesdales and one more look at New York, perhaps a moment of silence.
Mark, I have a hand in the air from one of our audience members. It's our buddy Len. And Len, you're self-muted. You'll have to unmute yourself in order to speak. Go ahead, Len.
Can you hear me?
Yeah, go ahead,
We
Len.
can.
Greetings,
Okay.
Len.
Yeah, I just wanted to add to the ResMed discussion that ISRG, Intuitive Surgical, is being knocked down price-wise by the same rhino mindset that these weight loss drugs are going to change the world.
Okay. What's the rationale, Len? Have you been able to dig deep enough to?
Well, yeah, no, the rationale that I've discovered or found, I think, is that the weight loss drugs will reduce the need for bariatric surgery. If you can get the weight loss without surgery, perception-wise, it's a win-win for you. But ISRG, in their presentations, quarterly, discuss the same issue, and they are seeing some, what do you want to say, election of non-surgery, but they said that appears to be small. They don't anticipate a major decrease in their sales based on the adoption of the weight loss drugs.
And that's what you're seeing here in this dip down below 30 and this trough right here.
Yeah, and the one that I published yesterday, I think, what I see is the the 20-day moving average, the 50-day moving average, the 200-day moving average, and the share price are all headed in the same direction, down.
Okay. Under some serious pressure from the rhinos.
And my take on that was, well, yeah, I did start a little position in ResMed. I used to own it, and had a very nice game from about 2010 or 11 to 2021. And the reason I sold it at a multi 100% gain was because I was buying a condo, not because there was anything wrong with the stock.
Well, hopefully you've got a placard above your mantle that salutes in ISRG.
No, I'm talking ResMed now.
Oh, ResMed.
ResMed. I own ResMed. In fact, it's in the decisions manifest. I believe I commented on it and mentioned that, you know, I sold out. I think I was in it at 45 and sold out at 267.
Nice.
That money toward the condo purchase.
Good stuff. You know, back when I used to get the stocks that were being bought and sold and working on the magazine staff at Better Investing, a lot of times people would send explanations of why they sold. It would be new furnace, etc. So good stuff. All right. Thanks, Len. Anything else, Ken?
No, we've kept up pretty well on the question side, Mark.
All right. So we'll go ahead and sign off. Thanks, everybody, for tuning in. And again, look forward to our coverage of that movie. I think it'll be a good one. Sean and I have talked about getting together somewhere between here and Philadelphia to go to it, but could be fun. How about Punxsutawney? I wonder if they've got a movie theater in Punxsutawney. That could work.
But a geographically challenged, that's not the midpoint.
Okay. We'll do the best we can. Well, thanks, Kevin. Thanks, Matt. Thanks, Len. And of course, thank you again. Thanks, everybody.